For most people, nothing felt wrong. Streetlights still turned on at dusk. Traffic signals cycled as usual. Police patrols continued their routes. The city looked alive. Budgets had been approved. Employees were still being paid. Public services continued to operate. There were no riots, no emergency announcements, no visible collapse. Nothing appeared broken. But financial collapse rarely announces itself. It does not begin with sirens or headlines. It begins quietly. The earliest signs were small. Invoices were paid a little later than usual. Transfers were postponed until the next quarter. Hiring requests sat unanswered. No one panicked. City officials described the situation as temporary. Budget committees promised reviews. Reports used careful language, words like shortfall, words like adjustment, words like under control. No one used the word crisis. They never do at the beginning. At first, the changes felt reasonable. Reduce overtime, postpone vehicle replacements, delay equipment upgrades. These were framed as efficiency measures, prudent management, fiscal responsibility, and on paper, they were. Each decision made sense in isolation. But the cuts were not evenly distributed. They never are. From the outside, the city still functioned. Garbage was collected. Schools opened on time. Emergency calls were answered. This is why financial decline is so dangerous. It hides behind routine. As long as services continue, people assume stability. But stability is not the same as solvency. And by the time failure becomes visible, the decisions that caused it are already years old. One morning, the city faced a question it had never planned for. Not how to improve public safety, not how to expand services, but whether it could afford to maintain them at all. Police hiring was frozen indefinitely. Overtime was eliminated. Patrol coverage was reduced. The city had crossed a line. It still existed, but it could no longer fully protect itself. What happened next was not sudden. It was mechanical. A system responding exactly as it was designed to respond. To understand how the city reached this point, we need to step back, because cities do not fail the way people think they do. They fail quietly, through math, through incentives, through promises that outlive the conditions that made them possible. To understand how a city reaches the point where it cannot pay its police, we need to step back. Cities do not fail the way households fail. A family runs out of money when income stops. A business fails when expenses exceed revenue. Cities are different. They can keep operating long after the math no longer works. That is what makes their collapse so difficult to recognize. Cities do not save money the way people do. They do not build large emergency reserves. They do not plan for extended decline. Instead, cities are designed to operate continuously. Money comes in, money goes out, promises stretch forward. As long as those flows continue, the city appears healthy, even when it is not. City revenue comes mostly from taxes, property taxes, sales taxes, local income taxes. These sources respond slowly to change. When an economy grows, tax revenue increases gradually. When an economy weakens, revenue does not collapse overnight. This creates the illusion of stability. The city still collects money, even after the underlying economy has started to erode. Because revenue declines lag reality, cities often believe they have more time than they do. Jobs may already be leaving. Businesses may already be closing. Residents may already be moving away. But tax receipts still arrive. The warning signals are muted, and decisions continue to be made as if nothing fundamental has changed. Debt behaves very differently. When a city issues bonds, it receives money immediately. Large sums arrive at once. Projects get funded. Gaps get filled. Debt feels like relief. It allows cities to delay difficult decisions, raising taxes, cutting services, renegotiating promises. But debt does not remove the problem. It moves it forward in time. Debt is attractive because it spreads pain beyond the present. Current residents receive the benefits. Future residents inherit the cost. This aligns perfectly with political cycles. Promises are rewarded now. Consequences arrive later. By the time the bill comes due, the decision-makers are often gone. It moves it forward in time. The third engine is the quietest. Promises, pensions, healthcare obligations, guaranteed benefits. These do not appear as immediate cash outflows. They sit in the background, growing, compounding, ignored. They are easy to underestimate because they do not demand payment today, but they always demand payment eventually. Problems begin when these three engines move at different speeds. Revenue slows, debt accelerates, promises continue unchanged. The city fills gaps with borrowing, assumes growth will return, assumes investment returns will compensate. For a time, it works. That is what makes the system so dangerous. From the outside, everything looks deliberate. Budgets are balanced on paper. Services continue. Reports appear orderly. Decline is managed, not announced. This is why cities rarely collapse. They hollow out. Services weaken. Response times lengthen. Maintenance is deferred. The structure remains. The capacity does not. Once the engines are misaligned long enough, correction becomes painful. Raising taxes risks accelerating population loss. Cutting services reduces quality of life. Renegotiating promises creates political backlash. Each option worsens another problem. There is no clean solution, only trade-offs. The city in our story did not fail because of one bad decision. It followed a system that rewards delay and optimism. To understand how this unfolded in practice, we need to look closely at revenue itself, because the slowest engine is often the one that decides the outcome. Of all the forces shaping a city's finances, tax revenue is the slowest to speak. It does not react instantly. It does not flash warnings. It does not panic. It drifts. That slowness creates comfort, and comfort delays action. By the time tax revenue clearly declines, the real damage has often already occurred. Most cities rely on three main tax sources: property taxes, sales taxes, and local income taxes. Each responds to economic change differently. Property taxes move the slowest of all. They are assessed infrequently. They are buffered by valuation methods. They often lag reality by years. This lag is not a flaw. It is a design choice. When a local economy weakens, property values do not immediately collapse on paper. Assessments are based on prior data. Appeals take time. Revaluations are staggered. For a while, tax bills still arrive. From the city's perspective, nothing seems wrong. Revenue appears stable, even as demand weakens underneath. Sales taxes respond faster, but still imperfectly. Consumer spending often holds up longer than employment. People continue shopping even as savings decline. Credit fills gaps. Optimism lingers. This creates another illusion. Spending continues until it doesn't. When sales taxes fall, they fall suddenly. Local income taxes introduce a different problem. They depend on people staying. When higher-earning residents leave, the tax base erodes disproportionately. A small number of departures can remove a large share of revenue. This is not always visible immediately. High earners move quietly. Addresses change. Payrolls adjust. The city notices later. Taken together, these delays create a dangerous window. Jobs may already be gone. Businesses may already be closing. Residents may already be planning exits. But the city's revenue reports still look acceptable. Decisions are made based on backward-looking data. This is how decline accelerates unnoticed. When revenue holds steady, leaders interpret it as resilience. They assume the downturn is temporary. They expect recovery. They delay hard choices, raise taxes later, cut services later, renegotiate obligations later. Later becomes too late. At this stage, raising taxes seems logical. The city needs revenue, rates go up, but higher taxes increase pressure on remaining residents. Some leave, others reduce spending, investment slows, the tax base contracts again. Revenue does not rise as expected. On paper, budgets still balance. Cuts match declines. Borrowing fills gaps. The numbers appear controlled. But balance does not mean health. It means survival. And survival is not sustainable. Eventually, the lag ends. Assessments reset. Sales fall sharply. Income disappears. Revenue finally reflects reality. But by then, obligations are locked in. Debt remains. Promises remain. Only services remain adjustable. The city did not ignore warning signs. The signs simply spoke too slowly. By the time revenue told the truth, the largest obligation was already unavoidable. A promise made long ago. A promise that never adjusted. Every city has expenses it can reduce. Maintenance can be deferred. Projects can be delayed. Hiring can be frozen. But there is one obligation that does not respond to pressure. Pensions. They do not pause during downturns. They do not shrink when revenue falls. They do not negotiate easily. They simply continue. Most municipal pensions were created decades ago, at a time when cities were growing, when workforces were young, when life expectancy was shorter. The deal was straightforward. Work for the city long enough, and the city will support you for life. At the time, this seemed responsible. It rewarded loyalty. It attracted workers. It stabilized the workforce. Few questioned the long-term cost. The math depended on three assumptions: a growing workforce, steady population growth, strong long-term investment returns. As long as new workers outnumbered retirees, contributions covered payments. As long as markets performed well, investment income filled the gaps. On paper, everything balanced. Then the population aged. Workers retired. Fewer young employees replaced them. At the same time, people lived longer. Retirement periods extended from years into decades. Each retiree drew payments longer than expected. The promise expanded without changing its terms. As the ratio shifted, contributions no longer covered payouts. The pension system relied more heavily on investment returns. Market performance mattered more. Volatility mattered more. Small shortfalls began to appear. They were labeled temporary. Pensions rarely demand immediate cash increases. They operate in the background. Shortfalls are smoothed. Losses are amortized. Gaps are projected decades forward. This creates comfort. Elected officials can promise future fixes without funding them today. The system appears stable until it isn't. Unfunded liabilities do not stay still. They grow. Each year, a shortfall is left unaddressed. Interest accrues. Future contributions must be higher to compensate. What begins as a manageable gap slowly becomes structural. Once pensions are promised, they are often legally protected. Courts treat them as contracts. Reducing benefits can violate state constitutions or labor agreements. That makes pensions politically and legally rigid. They cannot be adjusted easily, even when circumstances change. When revenue falls, pension payments continue. Cities must find money elsewhere. They cut services. They defer maintenance. They reduce staffing. Active workers and residents absorb the pain. Retirees remain protected. This creates tension. Rather than confront the scale of the problem, cities often rely on optimism. Markets will recover. Returns will improve. Growth will resume. These beliefs delay hard decisions. Each delay increases the cost of correction. Eventually, pension costs consume a growing share of spending. What was once manageable becomes central. Budgets are built around pensions, not services. At this point, flexibility disappears. The city becomes trapped. The promise itself was not reckless. What made it dangerous was the assumption used to justify it. A single number. Quiet. Technical. Rarely questioned. The assumption that changed everything. Buried deep inside pension reports is a number few people ever read. It is not a headline. It is not debated publicly. It rarely appears in speeches. It is called the assumed rate of return, and it quietly determines everything. The assumed rate of return is simple in theory. It is the percentage a pension fund expects to earn each year on its investments, 7%, sometimes 7.5%, sometimes 8%. On paper, this single number transforms future obligations into present costs. A higher assumption makes future promises look affordable today. A lower assumption reveals how expensive those promises really are. These assumptions were not chosen randomly. They were chosen during long bull markets, during periods of strong economic growth, during decades when interest rates fell steadily. Historical averages looked reassuring. Decision-makers believed the future would resemble the past, and for a time it did. A difference of 1% does not sound significant, but over decades it is decisive. A pension expecting 8% will appear well-funded. The same pension expecting 6% may show a massive shortfall. Nothing else changes, only the assumption. Imagine a pension that owes $1 billion 20 years from now. At 8%, the city needs to set aside far less today. At 6%, it must contribute dramatically more. The promise is identical. Only the math changes, and the math determines policy. Lowering return assumptions forces immediate consequences. Required contributions rise, budgets strain, cuts become unavoidable. This creates resistance. No elected official wants to raise contributions to pay for promises made long ago. So the assumption remains optimistic. Over time, markets change. Interest rates fall. Bond yields decline. Safe returns disappear. To chase higher returns, pension funds take more risk, more equities, more alternatives, more leverage. This increases volatility. When markets fall, losses are immediate. But pension accounting does not force instant recognition. Losses are smoothed, amortized, spread over years. This delays the shock, but it does not remove it. Each year, a shortfall is deferred. Interest accrues. Future contributions must be higher to compensate. What could have been corrected early becomes structurally embedded. The window for easy fixes closes. Optimistic assumptions persist because they solve political problems. They keep budgets balanced on paper. They delay painful trade-offs. They preserve the appearance of control. As long as markets cooperate, no one complains. When markets do not, the damage is already done. Eventually, reality intrudes. Returns fall short repeatedly. Demographics worsen. Contribution rates spike. At this point, the pension dominates the budget. The city loses flexibility. Every dollar diverted to pensions is a dollar not spent on services. When contributions rise beyond tolerance, cities look for relief. They turn to borrowing. Debt becomes the bridge between optimistic assumptions and unavoidable reality. Borrowing buys time. But time is not the same as a solution. Municipal debt arrives all at once. Large sums appear immediately. Gaps are filled. Payments are made. There is no immediate pain. Services continue. Taxes remain unchanged. Promises are honored. From the outside, nothing looks different. That is what makes debt so dangerous. Borrowing is justified with reasonable arguments. Growth will return. Markets will recover. Rates are low. Debt is framed as a bridge, not a solution. A temporary measure until conditions improve. And for a while, it works. When cities issue bonds, they promise future repayment. Investors provide capital today in exchange for interest tomorrow. Bond buyers are not emotional. They are mathematical. They assess creditworthiness. They evaluate revenue stability. They price risk. As long as the math works, the market responds. Once borrowing is used to solve one problem, it becomes easier to use it again. Each new issuance feels familiar. Each payment feels routine. The city becomes dependent on access to credit. Debt stops being a tool. It becomes a requirement. Debt does not disappear. Old bonds mature. New bonds replace them. This is called rolling debt. As long as interest rates remain low, the cost appears manageable. But the principal remains, and the total obligation grows. Borrowing is often used to support pension systems. Sometimes explicitly, sometimes indirectly. Debt payments compete with pension contributions. Both are fixed. Neither can be delayed indefinitely. This squeezes everything else. As debt service rises, budgets lose flexibility. More revenue is locked in. Less remains discretionary. At this stage, small shocks create large consequences. A mild downturn becomes a crisis. Debt postpones consequences. It allows cities to avoid raising taxes immediately, cutting services aggressively, renegotiating promises. Each delay feels rational. Each delay increases future costs. Over time, investors notice patterns. Debt levels rise, pension obligations remain unresolved, revenue growth weakens, credit ratings are adjusted, sometimes slowly, sometimes abruptly. Borrowing becomes more expensive. Higher interest costs consume more of the budget. Debt stops feeling like relief. It becomes pressure. New borrowing is used to service old borrowing. The city is no longer buying time. It is borrowing from it. Debt only works as long as markets cooperate. Eventually, the bond market responds, not with outrage, not with headlines, with silence. And silence is decisive. Markets rarely shout. They do not issue warnings. They do not hold press conferences. They do not explain themselves. They simply respond. And when confidence fades, they respond by withdrawing. Silence becomes the signal. Bond markets speak through prices, through yields, through demand, through participation. As long as investors believe repayment is likely, they show up. When doubt creeps in, they ask for higher compensation. When doubt becomes concern, they step back. At first, nothing dramatic happened. Auctions still cleared, bonds still sold, but yields were slightly higher, maturities slightly shorter. These were technical adjustments, easily dismissed. Credit ratings followed quietly, outlooks shifted, warnings appeared in footnotes, language softened. No single downgrade caused panic, but each adjustment narrowed the margin for error. Borrowing costs rose. Eventually, participation weakens. Fewer bidders appear. Orders thin out. The city may still raise funds, but only at a cost. Higher interest, stricter terms. The market is no longer enthusiastic. Then comes the moment no city wants to face. An auction that fails. Not because of scandal, not because of headlines, because demand simply isn't there. The silence is unmistakable. A failed auction changes everything. It signals loss of confidence. Borrowing is no longer assumed. It must be negotiated. Every future issuance becomes uncertain. The city loses its financial buffer. Investors are not judging morality. They are judging risk. They see rising obligations, flat revenue, limited flexibility. They price accordingly. When risk exceeds tolerance, they leave. Panic creates volatility. Silence creates paralysis. Without buyers, plans collapse, budgets unravel. Emergency measures replace long-term planning. At this point, choices are limited. Raise taxes aggressively. Cut services deeply. Seek outside intervention. None are painless. None restore confidence quickly. The market has already moved on. When borrowing ends, reality accelerates. Promises remain. Debt remains. Only services adjust. And public safety feels it next. For years, the damage was abstract. Numbers on reports, assumptions in spreadsheets, warnings buried in footnotes. Then it became real. Police hiring stopped. Overtime vanished. Vacancies went unfilled. For the first time, the city's decline showed itself in daily life. Police departments are large. They are labor-intensive. They are expensive. That makes them visible targets. Cutting a police budget produces immediate savings without shutting down the city entirely, at least at first. The first changes felt manageable. Response times lengthened slightly. Coverage areas expanded. Officers worked more hours, but capacity eroded quietly. Burnout increased. Morale declined. Experience walked out the door. The system still functioned, just less reliably. Experienced officers have options. They leave for neighboring cities, for better pay, for better support. New recruits do not replace them. Hiring freezes prevent replenishment. Training pipelines stall. The department grows younger, thinner, and more fragile. Response time is a leading indicator. It reflects staffing levels, morale, and operational stress. As response times increase, outcomes worsen. Incidents escalate. Confidence erodes. Residents notice. Public safety influences everything else. When it weakens, businesses hesitate to invest. Residents consider leaving. The tax base shrinks further. Revenue falls again. The feedback loop tightens. Not all services can absorb cuts equally. Road repairs can be delayed. Projects can be postponed. Public safety cannot. Once staffing falls below a threshold, failure accelerates. There is no gradual slope, only a cliff. Eventually, the city admits the truth. Not publicly, not dramatically, internally. Leadership acknowledges that full service levels are no longer possible. Coverage is reduced permanently. Public safety becomes selective. Residents adjust quietly. They avoid certain areas. They change routines. They rely on private solutions. Those who can leave, do. Those who cannot, adapt. The city continues to exist, but trust is gone. Once public safety weakens, recovery becomes difficult. Confidence is fragile. Even if finances improve, rebuilding trust takes years. Some cities never recover it. A city unable to protect its residents has crossed a symbolic line. The system no longer fulfills its most basic function. This is not collapse by explosion, it is collapse by withdrawal. At this stage, everyone looks for someone to blame, but blame misunderstands the problem. This outcome was engineered by incentives, not individuals. To understand why no one stopped it, we must look at how decisions were rewarded. When systems fail, people look for villains. A corrupt official, a reckless decision, a moment where someone should have said no. But in this case, there was no single moment, no dramatic vote, no clear turning point. What happened was slower and more ordinary. The city did not collapse because leaders were ignorant. It collapsed because incentives rewarded delay. Short-term stability was praised. Long-term sustainability was abstract. Officials were evaluated on what happened now, not what would happen later. The system rewarded appearances. Political cycles are short. 2 years, 4 years. Financial obligations span decades. Promises made today outlive the people who make them. Consequences arrive after careers end. This disconnect shapes decisions. Hard truths are unpopular. Raising taxes invites backlash. Cutting services angers voters. Renegotiating pensions triggers lawsuits. Delaying action feels safer. Each delay is defensible. Each delay is rational. Collectively, they are destructive. Accounting standards soften reality. Losses are amortized. Shortfalls are projected. Assumptions smooth volatility. This creates plausible deniability. The problem exists, but not urgently. It can be addressed later. Warnings did exist. Actuarial reports, rating agency notes, independent audits. But they were technical, quiet, easy to dismiss. They lacked urgency, and urgency drives action. Decisions were distributed across committees, across administrations, across decades. No one owned the entire outcome. Responsibility diffused. Accountability disappeared. As long as the city functioned, leaders assumed the system worked. Services continued. Budgets balanced on paper. Debt markets remained open. Normal operation became proof of health. It was not. It was inertia. Reform requires crisis. Before crisis, reform feels unnecessary. During crisis, reform feels impossible. The window for painless correction is narrow. It closed quietly. No single person caused this. The system produced it. Incentives aligned toward delay. Optimism replaced caution. Short-term calm replaced long-term stability. The outcome was predictable. By the time the problem was undeniable, choices were limited. Cuts were deeper. Borrowing was expensive. Trust was broken. Understanding arrived after options disappeared. What remains now is not outrage. It is a ghost, a city still standing but altered. To understand what lingers after the money leaves, we must look at what remains. The city did not disappear. Its streets remain. Its buildings still rise. Its name still appears on maps. From a distance, it looks intact. This is what makes financial collapse difficult to understand. The structure survives. The capacity does not. Some services returned. Others never did. Budgets stabilized, but only at a lower level of function. Public safety coverage remained reduced. Maintenance schedules stretched indefinitely. The city learned to operate with less than it once had. This became the new normal. The pension obligation still exists. It did not disappear with reform. It did not vanish with austerity. It remains embedded in the system. Each year, it claims a share of revenue before any new priorities are considered. The past continues to consume the present. Those with options often leave. They move to cities with stronger services, lower risk, and better prospects. Those who remain adapt. They adjust expectations. They lower demands. They accept trade-offs. The city becomes smaller in ambition, if not in size. On paper, the city survives. Budgets balance, debt is serviced, reports are filed, but something intangible is gone. Confidence. Once lost, it is difficult to restore. This city is not unique. The same mechanics exist elsewhere. Similar assumptions, similar promises, similar incentives. The pattern repeats quietly across jurisdictions. Different names, same math. By the time failure is visible, the decisions that caused it are long past. Warnings arrive late because systems reward delay. The collapse feels sudden. It is not. It is cumulative. This is not a story of corruption. It is not a story of incompetence. It is a story of structure, of incentives aligned toward optimism, of systems designed to defer pain, of promises that outlive conditions. The city still stands. Police still answer calls. Streetlights still turn on. For now. But the question is no longer whether the money leaves. It is whether anyone notices before it does. Financial collapse does not arrive as destruction. It arrives as absence. What once worked no longer does. What was promised can no longer be delivered. And what remains is a quieter version of what once was.